There's a version of you, same intelligence, same job, same general path, but they end up with 5, 10, maybe even 20 times more wealth than you. Not because they were smarter, not because they had better connections, not because they took some wild, risky bet. They just started earlier. That's it. And here's the part that feels a bit off. Most people don't notice this gap while it's forming. It doesn't show up in your 20s. It barely whispers in your 30s. It hits later, quietly, when time stops being flexible and starts becoming expensive. You'll see someone your age, same vibe, same background, but they're calm about money, not stressed, not chasing every opportunity, not trying to figure it out. They move differently, and you don't fully understand why. So you start asking yourself, what did they do differently? And the answer is frustratingly simple. They didn't wait. But here's where it gets a bit dangerous, because most people don't think they're waiting. They think they're being smart. I'm learning first. I'll start when I earn more. I just need a better setup. Sounds reasonable, responsible even, but in reality, it's just delay with better branding. And that delay, it compounds harder than money ever will. 1. The lie that sounds responsible. It usually starts with a calm, logical thought. I'll start investing when I make more. Fair enough, you don't want to mess it up. You don't want to feel tight on cash. You want to do it properly. But pause for a second. When exactly is more? Because what actually happens is subtle. You get a raise. Life improves a little. You upgrade a few things. Nothing crazy. Just a slightly better version of your current life. Better food, maybe a nicer place, more convenience. And suddenly, your new income doesn't feel like more. It feels normal. So investing gets pushed again. Next year for sure. Quick question. How many next years have already passed? This is where things quietly shift. Because investing isn't about having extra money. It's about building the behavior before your lifestyle expands to consume everything. If you don't, your future income gets pre-spent. Not aggressively, not irresponsibly, just automatically. You don't even notice it happening. It's like your life upgrades itself behind your back. And suddenly, there's no space left to invest. Not because you're bad with money, because you adapted too well. And here's the uncomfortable contrast. The early investor didn't wait for perfect conditions. They started small, almost annoyingly small, amounts that felt insignificant. While you were thinking, planning, optimizing, they were compounding. And that difference? It doesn't look like much at first. In fact, it looks pointless, but over time, it becomes everything. And this is where most people get it wrong. They underestimate how powerful starting badly actually is. Because starting badly still means you started. Waiting perfectly means you didn't. 2. Time doesn't care about your future plans. There's this quiet assumption most people carry. I can always catch up later. Work harder, earn more, invest bigger, fix it in your 30s or 40s. Sounds solid. But here's the issue. Time doesn't scale the way effort does. You can double your income. You can triple your savings rate. But you can't multiply time. Once it's gone, it's gone. And compounding, it's built on duration, not intensity. Let that sit for a second, because this is where the gap really starts forming. 2 people invest, same market, same strategy. One starts at 22, the other starts at 32. 10-year difference. Doesn't sound massive, yeah? But that first person gets 10 extra years of compounding, doing quiet work in the background. No effort required, no extra intelligence needed, just time. Meanwhile, the second person, they feel fine at first. They're earning more. They can invest bigger amounts. Feels like they're catching up. But they're not, because they're missing the one thing money can't buy back. And here's where it gets a bit uncomfortable. Late investors often feel pressure, not immediately, but eventually they realize they're behind, and they try to fix it fast. So they start chasing higher returns, jumping into trends, taking bigger risks than they normally would. Not because they're reckless, because they're trying to compress time. But compressing time almost always means increasing risk, and risk under pressure tends to go sideways. Meanwhile, the early investor, they don't need to rush. They don't need to chase. They can stay boring, and boring quietly wins. That's the part nobody likes to hear. The advantage isn't excitement, it's patience. And patience only works when you started early enough to afford it. So the real question becomes, are you actually early? Or does it just feel like you are because you haven't seen the consequences yet? 3. The life you don't realize you're trading away. Here's something people don't usually connect. The cost of delaying investing isn't just financial. It's behavioral. It shapes your entire life, slowly. Think about it. Right now, your financial position influences the job you tolerate, the risks you avoid, the opportunities you say no to, even the way you think. If your investments haven't had time to grow, You rely more on your income, which means you protect your income, which means you play it safe. And over time, that safety becomes a constraint. Not immediately. At first, it feels responsible, stable, sensible, but then something shifts. You want more freedom, more control, more flexibility. And that's when you notice you don't fully have it because your money hasn't been working long enough. Pause for a second. Imagine two versions of your life. Same income, same intelligence. But one has a decade of consistent investing behind them. The other doesn't. Who has more options? Who can walk away from a bad situation faster? Who can take a risk without everything collapsing? That difference? That's not luxury. That's leverage. And leverage compounds just like money does. Early investors slowly build that leverage in the background. Late investors, they feel the lack of it, not in obvious ways, in subtle ones. Hesitation, second-guessing, delaying decisions. And over time, those small hesitations shape your entire path. This is where it gets real. The wealth gap isn't just about numbers. It's about control over your life. And control is built quietly, long before you realize you need it. 4. The discomfort moment. Let's be honest for a second. This might be about you. Not in a dramatic way, in a quiet, slightly uncomfortable one. You already know investing matters. You're not against it. You're not ignoring it. You just haven't fully locked in. Maybe you've started and stopped. Maybe you've been learning for a while. Maybe you're waiting for the right moment, the right income, the right system. But if nothing changes, where are you in 5 years? Still planning? Still preparing? Still telling yourself you're early because you're younger than someone else? That's the trap. Early isn't about age. It's about action relative to time. There are people in their mid-20s who are already late, not because they missed everything, because they kept delaying something simple. And there are people in their 30s who are still early because they finally started and stayed consistent. So the question shifts. It's not, am I too late? It's, how much longer am I willing to delay? Because every delay compounds, just not in your favor. And here's the part most people don't say out loud. You don't feel behind until it's too late to fix it easily. That's what makes this dangerous. It's invisible until it isn't. Here's the shift that changes everything. Stop treating investing like a future decision, something you'll optimize later, something you'll get serious about when life feels more stable. Because that moment, it doesn't arrive the way you think it will. There's always something, a new expense, a new goal, a new reason to delay. So instead, treat investing like a system, something that runs whether you feel ready or not. Calm, automatic, consistent, no drama, no overthinking, no perfect timing, just structure. Because the goal isn't to invest perfectly. It's to invest long enough for time to do its job. That's it. And once you see it that way, your focus shifts. You stop asking, how do I maximize returns? And start asking, how do I make this unavoidable? Because consistency beats optimization every single time. You don't need to win big. You need to stay in the game long enough, quietly, while everyone else is still deciding. And something interesting happens when you do this. The anxiety around money starts to fade, not instantly, but gradually, because you've changed your relationship with time. You're no longer reacting to it. You're working with it. And that creates a different kind of confidence. Not loud, not flashy, just steady. You stop feeling like you're behind because you know you've started properly and you're letting it run. That's the real advantage of early investing. It's not just the extra money. It's the reduced pressure, the ability to make decisions without everything depending on your next paycheck. The calm that comes from knowing you gave yourself time, and time is doing what it does best. Compounding, quietly, in your favor. You don't need to be perfect from here. You don't need to catch up overnight. You don't need a massive income. You just need to stop delaying. Because the gap between early and late investors, it's not built on knowledge. It's built on hesitation. And the moment you remove that, you're no longer stuck. You're just in motion. If this hit, even slightly, there's something you need to see next. Because starting early is one part of the equation. But what you do consistently after that, that's where most people quietly lose millions. Without realizing it, there's a completely normal money habit. Feels harmless, looks responsible. Almost everyone does it. But over time, it destroys the very compounding advantage we just talked about. And the worst part? You won't notice it while it's happening, until it's already cost you years. So the next step isn't more motivation. It's awareness. Watch the normal money habit that costs millions over time. Because understanding the gap is one thing. Protecting it, that's where your future actually changes.